Well, thanks everyone for joining us. We appreciate everyone taking the time today to be with us. For those of you I haven't met, I'm Mike Levy. I'm a partner with Integris Wealth. I serve as the Chief Investment Officer for the firm. Been with the firm about 22 years. I joined our founder, Giff Lehman, back in 2004. Prior to that, I worked in institutional investment management in the San Francisco Bay Area, and I grew up around here, actually, in Big Sur, moved back to the area in about 2001. And joining me today is Apollo Lepescu. He's with Dimensional Fund Advisors, also known as DFA. It's an excellent investment management firm. We use a number of their funds in our client portfolios. Apollo's been with DFA for over 20 years. One of the things he does really well to help us out is to put current events into historical perspective and translate what can feel like really complex dynamics into something much more, understandable for investors. Apollo has a PhD in economics and finance from UC Santa Barbara, BA in economics from Michigan State. He taught within the UC system a long time before joining DFA. But frankly, what really qualifies him to join us today is that he played and coached water polo at the university level, and he's still an avid surfer. And for those who know Apollo, his ability to simplify these complicated topics has earned him a pretty great nickname, the Secretary of Explaining Stuff. So with that, I'm going to ask Kay to step in. Today we're going to talk about the global environment. Apollo will give us some insights on that, but I'm going to ask Kay to step in first and give us some tips about how to navigate this webinar.
Thanks, Mike. And if you're new to our Zoom webinars, I'd like you to know that we really appreciate engaged audience engagement here at Integris. For the Q&A portion of this webinar, go ahead and navigate to the toolbar at the bottom of your screen. You should see a speech bubble with a question mark in it, and you can submit your questions there. I'll be passing these questions along to Apollo and Mike as the presentation goes along, and all these questions will be private as well. Additionally, you'll just want to roll your mouse over to the upper right-hand corner of your screen to view, and go ahead and navigate to speaker view in full screen mode. Apollo uses a ton of graphics and charts and a lot of visual pictures, and it'll just give you the best possible viewing experience. Additionally, we do have a disclaimer we have to go through. This presentation is intended for educational purposes only and should not be considered investment advice. With that, I'll pass it back to Mike.
Thanks, Kay. So Apollo, let's just jump in. Maybe to start, you can just give us a high-level overview of the current environment, what you're seeing in the markets, what's taken place over the past few years, how all that brings us to where we are today.
Well, first of all, hi, Mike. Hi, Kay. Thank you so much for the invitation to be part of this webinar, and thanks to everyone for taking the time. And so, if we're going to rewind the tape a little bit and talk about the markets, I do have to say that it has been a quite a remarkable few years because the last time that we saw a significant prolonged market downturn was about 18 years ago. So along the way, we had a couple of negative years in 2018 and 2022. Nothing really tremendously bad. We recovered quite quickly. So I do have to say that there has been a lot of positive news for investors. And the market has been doing quite well. And as we know, the nature of the market is to fluctuate, but we've had a tremendously nice run as an investor. So I do have to think that most folks on this call are happy about it. But I do want to reflect back a little bit on this idea of the market has been doing so well. And why it's so important to maybe start by defining exactly what is the market and what does it mean to be invested in the market. Because you take something like the S&P 500, which is a broad measure of the U.S. market. It encompasses the largest 500 companies roughly in the U.S. market and the U.S. economy for that matter, and looks at their performance. And the way that you get from 500 individual performance numbers to a single one is not just by examining how each stock did, but there's one other consideration. You also want to consider how large is that company? How big is that company? In other words, you want to emphasize the performance of larger stocks more so than smaller stocks. And what I mean by large and small, it has to do with the value of ownership. How many shares of ownership does a company have? How much is each share worth it? And you get a sense of the value of that particular company. And in that respect, if you look at the Magnificent Seven, which are a group of stocks that have gotten this nickname because they're, really relevant to all of us. We all use these companies one way or another every single day almost. And they are associated with technology and AI, all this stuff. But what's also interesting about these Magnificent Seven is that they are some of the largest stocks in the U.S. stock market. And if you look at these seven stocks and you kind of take them aside, you separate them from the rest of the market. The reason that the Magnificent Seven are so important is because among the seven of them, when you add them together, their percentage in the S&P 500, they amount to roughly about 32% of the value of the entire S&P. In other words, when you say how did the market do, and you think about the S&P, about a third of the performance is coming from only seven companies. A third of the performance of the market is driven by seven stocks, which is quite a bit. I have to say it's quite a bit if you think about it. And the exact same seven stocks are also in a different market metric that is called NASDAQ, which are all the companies that have chosen that trading venue. NASDAQ is nothing more than a trading venue. It's like Safeway or Ralph's, and companies decide to trade on that particular market. And the same exact Magnificent Seven are also part of NASDAQ. But because a lot of the larger stocks, other larger stocks have not chosen NASDAQ, but let's say New York Stock Exchange, and they're not part of NASDAQ, the same Magnificent Seven, instead of being 32%, they amount to about 51% of the value of NASDAQ. So a very big part, more than half of the performance of NASDAQ is driven by seven stocks, which is quite concentrated, if you ask me. And to me, this has been really, really interesting because if you look at that group of stocks that I mentioned a second ago, which is the U.S. stock market, excluding these Magnificent Seven, well, that market, the S&P 500, excluding the Magnificent Seven, over the past decade, and you mentioned that, Mike, it has gone up by 200%, 200% over the past 10 years. So it's a really nice growth that you've had on your money over the past 10 years in the U.S. market, excluding the Magnificent Seven. So this is through the end of last year. Now, the Magnificent Seven, I think this is where the story is. They did not go up by 200%. Over the same exact period, when all the other stocks were up by 200%, these Magnificent Seven were on a tear. They went up by 999%. If they only tried a bit harder to get to 1,000, but they were, really did outstandingly well, significantly better than the remaining market. So to me, the first story that I would say is that over the past decade, the U.S. market has been in a way really propelled up by these Magnificent Seven because they're such a significant part of the way we measure the performance, both in NASDAQ and the S&P. And they have had a tremendous, tremendous performance, much more so than the remaining parts of the market. So when you say the market, the S&P 500 did really well, keep in mind that that about a third was driven by these incredibly high flying Magnificent Seven. Now, they've been running very, very high, and that's good news in there because if you participate in them, you also took part in that growth. The question is, looking forward, will they have the same room to grow? And what happened as these stocks went up and up and up? And one of the things that's been happening as they perform so well is that a metric of the market that's called valuation has also been going up. And what does valuation basically mean? So valuation means that you're paying a certain price. And if you look at some accounting metric, you can determine if the price of that particular stock is relatively low or relatively high. And just to make it real, because that sounds confusing, let's make it real. Let's say that you wanted to buy a share of Tesla. Well-known company. At the beginning of the year, it was roughly about $450 to buy one share of ownership in Tesla. Now, what does it mean to buy a share of ownership? It means that you can partake in the ownership of that business pretty much like Elon Musk. Not as much as Elon Musk, but you can certainly partake in that ownership, and you now have a claim to the profits that the company makes. So if you look at the time when this company was selling a share for, not the company was selling, but the share was trading at $450 a share, at the time, the earnings associated with that one share of ownership were roughly $1.50. So if you reframe this, you're looking and saying, okay, wait, so what just happened here? You just paid $450, and at that current level of earnings, Tesla would come and put $1.50 per year into your piggy bank. So in that respect, if you think about it as an investor, you just spend $450, and if you're going to get $1.50 at the current rate of earnings, how many years would it take for you to make that initial investment back? You spend $450 and you're going to get $1.50 per year. The math is not super complicated. It would take roughly about 300 years to be made whole. 300 years. That's a metric that we know as investors in jargon called price earnings. So if you heard the P ratio, it's just simply intuitively, what's the payback period on your investment at the current level of earnings? At the same time, there are companies that haven't really been on the forefront of AI. And you take another car maker, Toyota, a global car company, and at the time when Tesla was selling for $450, well, the price of a share of Toyota was less than half, $215 per share, and the earnings per share were not $1.50, but roughly about $20, which meant that it was about a 10 years payback period, which is much shorter. So valuation simply reflects on a relative basis which one of these companies is more expensive. And clearly, in this case, Tesla is more expensive. And the reason for this, and this is kind of why I'm kind of like talking about this, is that there's a bit of a cautionary tale. When these Magnificent Seven have been going up and up and up in value, their price has been going up, but not always have they kept up with profits. Their earnings haven't gone that much. So if you look among these Magnificent Seven and you look at their price earnings, which is kind of the intuition that I brought forth, in the U.S. stock market over the long run, it's in the 20s, low 20s. So Meta, which is the company that is the parent of Facebook, is the only one that is roughly in the ballpark. Apple, Microsoft, Alphabet, and Amazon, they're roughly about 50% above the long-term average of the market. And NVIDIA is about 2 times the average in the market. So if you think in that terms, Tesla is certainly an outlier, there was 300. So if you think in those terms, what it really comes about is that by going up so much, and by having such amazing performance, that's great news, but it's a cautionary tale because among these Magnificent Seven, their price earning or the payback period, whatever you want to call it, it's about 68. 68, which is quite high. It's well above the long-term average of the market. And to get a perspective, the remaining stocks, the ones that seemingly didn't do as well, their valuation is actually much closer to the long-term average. It's about 28. And in the U.S. market, you also have a group of smaller companies that have even a better valuation of about 18 below the long-term mortgage. And these are the companies that are not part of the S&P, but they still trade well in the market. And then within that subset, there is a small value component that has even a better valuation. So, Mike, you ask what's sort of the story over the past few years. In my opinion, the story over the past few years has been these Magnificent Seven and how well they've done. The fact that they have just had an outstanding performance, and it's great news because if you're an investor, you participate in them. At the current time, what I would caution folks is not to over concentrate, not to overdo it, whether it's in NASDAQ or the S&P, but rather pay attention to smaller company stocks, pay attention to value, and also pay attention to international stocks like Toyota. And when you combine all of this and let's say you have a global portfolio that includes these Magnificent Seven, but also about 10,000 plus other companies, and you approach it in that respect, I think one of the benefits is that you will reduce this concentration risk. You're not going to be overly concentrated in these relatively expensive stocks that have done so well. And in that respect, in a global portfolio, this should the Magnificent Seven would be about 18%. So you're not missing out on them. On the other hand, you're not so focused on them. So that to me is, I think, part of what I've seen over the past few years is just these incredible performance by these Magnificent Seven. Great news for investors, but also, is it time right now to basically say, how do I maybe take some chips off the table and not necessarily have to, bank so much and bet so much on a handful of companies?
And so I'm hearing diversification in the US for one thing, away from purely the S&P 500, and also global diversification going forward
Yeah.
is probably a good stance. Yeah.
Exactly right, and exactly right. I mean, that's the that's something that I think along the way should have always been a good theory and starting place for any investor, any portfolio.
Yeah, and we've been positioned like that for a while, which of course, but if we knew that this was going to happen, we would have been all in the US, but of course nobody ever knows, where we're going next. So we strongly believe in that global diversification.
Yeah,
Maybe
and
we
that
can. Oh,
yeah.
go ahead.
Go
Sorry.
ahead.
No, I was going to say maybe we can jump to the state of the world right now, what's going on in Iran, just other things, other big things that are moving the markets around. Maybe you can speak a bit to what does all that mean in this context?
Absolutely, and I think that particularly when it comes to Iran and politics in general, what I do find is that there's a real human element, and before we get talking about markets and numbers and dollars, it's probably really important to acknowledge. It is actually really important to acknowledge that there are families who have perhaps sons or siblings or parents who are deployed in the Middle East, and it's scary. I mean, it must be like a really terrifying time to know that they're in harm's way. So that's not to be minimized. At the
Absolutely.
same time, you have a lot of Iranians who last year they went in the streets and they really a lot of them died looking for freedom. And now not only that their government is back on top of them, but now they're even seeing bombs and they're unsure about survival. And so it's really terrifying. And what I find is that all of the suffering and all these images they do tend to trigger some very strong emotions from not just, I mean, for myself, for everybody. And that's normal because that's what makes us human. But Mike, over the years, one of the things that I've kind of come to appreciate is that successful investors can acknowledge these emotions because they're real. And that's perfectly fine to have. And at the same time, disentangle them from investment decisions. So when they look at markets, when they look at investing, it ought to be not based on how we feel, rather much more pragmatically on data and evidence and understanding the dynamics of the market.
Yeah.
And I think that's really important because quite often when emotions make us feel in a certain way, we want to take those emotions and act upon them when it comes to money. And I think, in my opinion, it is not the smartest thing to do. Most emotional decisions tend not to work out very well. And in that respect, the first thing that I have to note is that investing in the stock market, it is not about assessing the morality of an event. It is not, whether it's Iran war, whatever it is, it's not. It's rather about something much more fundamental. We talked about Tesla and the fact that if you buy a share, you can partake in the business ownership of that company. You are now a business owner into that company. So, in that respect, the value of any business, whether it's your local restaurant, it's your cafe, it's Apple, it's Tesla, any business, its value is generally derived from what do I expect to make in profits if I'm an owner in that business. That should be the fundamental premise. If I own a piece of a business, well, how much money is that business going to make? Because then I can partake into those earnings. So the market is really fundamentally asking when an event like the Iran war happened, what will be the impact of that event on the potential of a company to make money? That's the question. I know it sounds cold, but it's the right question because if you are a buyer, you want to buy a share of a business. Well, you certainly don't want to overpay if the business is not going to make as much money. Well, if it's not going to make as much money, it's not as valuable, and the market has to adjust that. And that's what it does every single second. If you want to sell, you make sure you don't undersell because you'd be shortchanged in the value of the ownership. So what the market's trying to do is answer this question. And to give you an example, the bombing of Tehran happened over the weekend. On Monday, when the market opened, take an U.S. airline that had flights to the Middle East and operations got disrupted. Is that business as valuable on Monday as it was on Friday before the bombing? Not really, because a lot of the things got disrupted. So the market naturally would say, well, you're not worth as much, and the stock price dropped. At the same time, if you have a U.S. defense contractor that now is likely going to receive more orders for military equipment, well, likely that business is now worth more, so the price went up. So the same event might have triggered completely different responses at different companies, but by and large, Monday afternoon when the market closed, the S&P 500 was pretty much unchanged. Like there's no change. And that's not that the markets disregarded the conflict or they didn't know whether there was a conflict over the weekend. Of course, everybody knew. It's just the assessment was that for the majority of American companies, take Shake Shack, take Buffalo Wings, take Danaher, you take it. For most of the American companies, this would not be a significant event leading to major changes into their operations or profits. I'm not sure about Apple, but I don't think they sell many iPhones in Tehran. I'm not sure how many Starbucks are in Iran. But by and large, there was a muted the muted day of trading because the assessment was that it's really unpleasant to see the suffering. On the other hand, it's not seemingly a very big impact on these companies. Now, by a few days later, when the Iranian strategy of closing the Strait of Hormuz became clear, the market adjusted and said, wait a second, the oil's going to go up, so consumers might not have as much money to spend on other things, and maybe we need to adjust prices. And you did see the market doing that. So the market's adjusting all the time, but it's not assessing morality. It's not assessing the emotional impact, but the practical impact. And at the same time, it's also good to know, folks, that whenever there is a challenge that a company or an individual or society has, what it tends to happen is that that's when people innovate. That's when companies become resilient. And it's quite possible that by the end, you might actually have a situation where the company or the country is actually stronger than before the event. So instead of looking at this Iran war and saying, wow, this is horrific, it's just going to be doom and gloom, you can also look at it from a positive way and saying what changes will happen down the road that will benefit U.S. companies, that will benefit the U.S. as a country that were triggered by this event. And to me, sort of an interesting example is the last time that we had a major oil crisis, which is 1973-74, when we didn't produce a lot of oil and we got most of it from the Middle East. And at the time, to show their displeasure with the U.S. policies, the Organization of Petroleum Exporting Countries, OPEC, decided not to sell oil to the U.S. And the result of that was horrific because at the time, there was no oil. People would be in line. I'm not sure how many folks on this call might remember those lines. And you'd be there for hours and hours and maybe days with no gas. And imagine how you would have felt. This is the end of it. We're done. We can't even put gas in our cars. This is terrible. And that is, something that interesting enough, what it led to is the idea that we don't necessarily want to build these gas guzzling cars that by the time you refill, go home, you have to go back because you're empty again. But much more fuel efficient cars, but also this idea of energy independence. Energy independence, which basically meant that we needed to produce more oil domestically. And over the next 50 years, the U.S. has accomplished exactly that. We are now a net exporter of oil, so we don't depend as much. But it all stemmed from that challenge. We had the same thing in the pandemic when companies couldn't, get together in person. Well, let's use Zoom. There are all kinds of examples. Cruise lines, they basically laid off people, brought them back later. All these companies are doing is they're saying, well, how can I continue to survive and thrive even in this terrible time? So it's quite possible that this particular crisis right now might lead to something that 10, 20 years from now might seem like an extreme positive. Maybe we're going to move away from oil and say, yeah, we really need to get beyond that and then find other source of energy. Maybe there are more electric cars. Who knows? But you can think of it as an opportunity to innovate, and people are resilient. Markets are resilient, and we see this over and over again. So I don't want to just undersell this idea that this is tough right now, particularly with prices going up and gasoline and so forth. For sure, I just want to caution not to overdo it, not to kind of say this is the end of it, this is horrific. No, the markets so far have signaled a lot of resilience because they do think that a lot of these companies will be okay and they'll be able to navigate what's in front of them.
I've seen some slides from DFA that show sort of geopolitical events like this in the past and how the markets have reacted afterwards. Do you have anything like that you could share, or maybe just talk about it either way?
Yeah, I mean, I think that there are plenty of slides, and we can send some afterwards that you can share with the audience.
Hmm.
What I find is that invariably the biggest thing is that the emotional side of the conflict when you see this happening, it's just like, yeah, that was in the past, but this is different this time.
Yeah.
And I find that sometimes people do look at the situation and say, yeah, I look at those charts, great, but this is different this time, and it feels different. And I was talking to some folks not too long ago, and they were saying, yeah, what if it gets worse and all that. So instead of showing you the historical one of a bunch of events, what I thought I would do is maybe kind of focus on one single event.
Hmm.
And that is World War II, because in my opinion, and talking to my mom and talking to a lot of folks, that was as different as it got. And that was as horrific as it got in modern history, because you have
Hmm.
tens of millions of people dead. I mean, it was just horrific. The destruction and everything was terrible. So if you look at the data, and if you go back to September of 1939, when Germany invades Poland, and you kind of say, wow, this is not good. The bombs are falling. Now we're going to go back into a war. It just felt different. And it would have been legitimate to say, this is different this time. It's unlike anything else we've seen. And if you somehow manage to stay invested in the market, and the only market that had data was the U.S. Stock market, the S&P 500, and you somehow stayed through August of 45 when Japan surrendered. So it's exactly 6 years of war. The question is, what was interesting for me to look is like, how badly did it get for U.S. investors in a period of just global devastation and death and destruction. And what's remarkable, Mike, is that $1 invested at the beginning of the war would have pretty much doubled in 6 years of war. 6 years of war. And this is remarkable. And obviously, we got pulled in August of December of 41 with Pearl Harbor. And if you look at the full years of U.S. engagement in the war, in every single year, the market went up. In every single year, the market went up. And the cynical view is that, oh, war is good for business. No. That's not. It kind of ties into what I mentioned earlier, is that whenever companies operate in free markets, they will find a way to innovate and navigate whatever is put in front of them. And if you are, for example, a car company or Cadillac, and you don't have buyers because the boys are fighting on the fronts in Europe and Asia, all over the world, and you just don't have enough buyers for your cars, well, what do? Do you just close shop and say, well, we don't have any customers? Well, not necessarily. What Cadillac did, for example, is they took their engine and they put it into a tank. And there was a
Hmm.
Cadillac tank. And I'm not sure it had leather seats or power windows, but hey, this is a Cadillac tank. And that's how they did it. Ford, instead of making cars, they start building airplanes and selling those to the government because that's what was needed. And they pivoted. And when you think of the tough, build Ford tough, it's not the F-150. The toughest Fords ever built were the tanks. And that's also when Jeep got started. And now, 70, 80 years later, it's still kind of going strong.
Hmm.
To me, you can look at a lot of examples throughout the years, but it's a fundamental premise. That the fundamental premise is that in free markets, companies will figure it out. And it might take a period to adjust. Not every company is going to make it. But the society, the markets, the companies, I do believe they're resilient. And there's so much data to show that they'll figure it out. And the pandemic was the same. look, Mike, we're all stuck at home. Nobody could leave. I wish I was in Big Sur, to be honest. Would have been an amazing place to be in. But companies still continue to operate, and eventually they emerge stronger. They absolutely emerge stronger.
Yeah, yeah, absolutely. Well, we do have a question from the audience, which was, what about bonds? So, what does all this mean for investors in bonds and fixed income securities?
Yeah, so bonds as opposed to stocks have a very different dynamic. And the dynamic in bonds is that with stocks, you own a piece of a business, and the value of the ownership depends on what the business is going to make. If the business is going to make more money, then I expect the price is going to go up. If not, it's going to go down. So there's a lot of uncertainty onto the earnings, and there's a lot of uncertainty on the value of a company. And that's why you see the markets fluctuate so much. Bonds, on the other hand, are about lending. Corporations and governments, they need to borrow money. And instead of going to a bank, they can come to us and say, hey, listen, why don't you lend me $1,000? And we'll write up a contract. And in that contract, we specify an interest rate that you'll receive for how long you get the interest rate. And at the back end, you get your money back. That's what a bond is. And in that respect, bonds have a fundamentally different dynamic because there is a contract. You can take a company to bankruptcy if they don't give you that interest payment. And so there's a lot more certainty in terms of what you receive as an investor. So bonds are about ownership, stocks are about ownership, bonds are about lending. So in that respect, when it comes to bonds and what's going on right now, the first thing to note is that different types of bonds have different dynamics. So not all bonds are going to be equally impacted. And one of the primary distinctions is the length of the contract. So if you look at the length of the contract, and for example, the U.S. government borrowing money for a month. In a month, you get your money back plus interest. Well, that's a very short-term loan that you give the government. And because of that, and you're dealing with a U.S. government which has never missed an interest payment or principal repayment, those bonds typically don't pay as much because there's not a lot of risk and it's a very short-term period. Now, if you lend the government, the same U.S. government, the money now for a longer time, let's say 10 years, well, it's a very different dynamic because now your money is going to be there, it's locked up for 10 years. So what historically investors have done is said, well, listen, you need to pay me a little bit more because my money is locked up for 10 years. So based on what's going on in there, the dynamic impacting the short-term bonds and the long-term bonds that in some ways it's similar is inflation. That's going to be the key ingredient there because the short term, those 30 days that I mentioned, those interest rates are greatly impacted by Fed actions. So Fed actions really matter. So if there is inflation, the Fed is going to say, well, we don't want inflation, so we might keep the rates where they are or even increase them because that's how the Fed fights inflation. So the current situation, what it's basically doing, and this has been happening over the past few months with the war, is that you've seen an uptick in inflation. The price level in the U.S. Has been going up. And if that's the case, it's quite possible that this inflation is going to keep these short-term rates higher, or they might even go even higher than where they are today, depending on the Fed actions. But a lot of the Fed actions are driven by by inflation, and inflation stays high. It's very unlikely the Fed is going to cut rates. So what's the impact to you? It means that if you're a business that hopefully that you're hoping that maybe if I take these short-term loans to make payroll, you're not going to get lower rates than what they are now, and maybe you're going to get higher rates because if the Fed increases the rates. On the other hand, if you are a saver and you had some money in a CD, well, those CDs are buying these 30 days rates, and they are actually that's good news for you if the rates go up or they stay where they are because then you make more on your money as a saver. Now, here's the thing. The long-term bonds is so interesting because that's where a lot of the action is. And what's going on right now has a much more direct and immediate impact. And why is that? if you are a saver who you're going to give somebody a loan, well, what you want is to at least be able to buy the same things today later on when you get your money back. So one of the bogeys, one of the hurdles that long-term bond investors, like say for 10 years, are trying to clear is, what do I expect inflation to be over the next few years? And I want to at least make as much, and then perhaps something on top of that. So to give you a practical example, if you go in September, this is before the election, the interest rate, the expected inflation over the next following 5 years, that is called a 5-year break-even inflation rate, was about 1.9%, which is exactly in line with the Fed's target. But by June, because of tariffs, because of other things, the expectation of inflation over the next 5 years had increased by about 0.7% to about 2.6. So what was the impact? The impact was that the 10-year Treasury had also increased by 0.7%. So in that particular case, what you saw is that there was a very direct and immediate impact, even as the Fed made no moves in that particular time frame. And one of the super interesting thing is that the 10-year Treasury, which is the longer term, has a significant impact on the mortgage rate. It's the backbone, it's the foundation of the, in a way, of the mortgage rate. And what you saw is that that mortgage rate also increased by roughly the same amount, 0.7%. So to me, when I look at what is going on at the moment, if you want to understand what's going to happen, is if you look at March. So if you look at March of this year, in 2026, this particular 5-year break-even inflation went up by about 0.2%. The interest rate on the 10-year went up by about 0.4%, because it is driven not just by the expected inflation, but how much does the government borrow, the risks associated with the Fed, and you also saw the mortgage rate also go up by 0.4%. So what is going on right now with the bond market? If you're curious, on the short end, it is still driven by the Fed, and the Fed really hasn't made any moves in the last few months, and they might or might not, gone down the road. But what you did see is that the 10-year, which is very, very significant to you, because that's what the mortgage rate is a lot of time attached to. And just to give you the perspective, this is the 10-year interest rate over the past 50 years or so. And this is the mortgage rate overlaid on top of that. So just visually, it's clear that to me that the two of them are related. And to me, again, what you're seeing is that this longer term rates are impacted by the expected inflation and by the government borrowing and the risk associated with the Fed independence. And because of that, you've seen, even without the Fed making any moves, some changes to the bond interest rates.
What do you think? You've got Kevin Warsh coming in as the new Fed chair, and there's been a lot of talk about him potentially being more likely to lower rates. What do you think? What do you think about that? And what kind of should we be thinking about that at all, basically? And how does it?
No, it's a really important question because I believe that Fed independence is one of the reasons why the U.S. has been incredibly successful economically over the past 50 years.
Mhm.
No doubt in my mind that wasn't one of the main reasons. And I'll give you two perspectives. The first one is that, and this is just 2 minutes on this background because it's really important, is the Federal Reserve is the entity that releases dollars in society, not the government. The Fed releases money in society. And for the good part of the 20th century, that the Fed was constrained in its ability to release dollars because we had something called the gold standard. In other words, the Fed had to have a certain amount of gold in the bank for every dollar that got issued. And in that respect, the Fed couldn't just issue money left and right. Now, in the late 60s, early 70s, economists pointed out that, wait, we're just not digging up enough gold to print all the dollar bills that we need. So it turns out that in August of 71, President Nixon goes on TV and he tells the world that as of today, the dollar is no longer connected to gold. So at that point, you can run the printing machine day and night, no backstop, and that freaked people out. It's just that again, the ability to release dollars did not rest with the government, but the Fed. So when this happened in the early 70s, right now the Fed is like, well, actually, I can release as many dollars in society as I want. And in the early 70s, all the way through the late 70s, the Fed was making decisions not based on economic policy, but the influence of politicians. And it's well acknowledged that they're very influenced by politicians. And because of that, what happened was they lost credibility. People didn't believe that the Fed was making the correct decisions based on data, but rather what's good for politicians. And because of that, the 1970s had terrible inflation, terrible economic output. We have a situation called stagflation. The economic output was terrible, the inflation was high. And that was a lot, in my opinion, caused by the distrust that people had in the Fed. And if you don't trust that the Fed is going to do the right thing to kind of keep inflation on the check and they're going to make political decisions, tell you what, if you're a union negotiating a contract over the next 5 years and you expect the inflation is going to stay high because the Fed's not going to do much, well, you're going to bake that into a contract. And at that point, inflation becomes a self-fulfilling prophecy. And that was the case in the 70s until late 70s when a new Fed chairman came along. His name was Paul Volcker, and he said, no more monkeying around. We're going to be fiercely independent. We're going to make decisions based on data. We're going to fight inflation and reaffirm the confidence in the Fed that we're going to make the right decision. And he did that, and he accomplished it. And since 1980 or so, for the past 45 years or so, we've had an amazingly successful run because of this confidence that the people had that if inflation was to come up, the Fed will make the right call, even if it might not be in the political interest of whoever's in the White House. And that's when a lot of the folks got really spooked. It's like, wait a second, what if the White House can now dictate policy? Well, we're going to go back to the 70s, and that was really terrible. So, that's why so many people were concerned about Fed independence. With that being said, I also have to say that you don't want to overblow this because this is not one Fed chairman making decisions and laying down. Yeah, he might have a bit of a louder voice, and he perhaps might have the ability to speak on behalf of the BAP. But there are 12 voting members on the Fed. And all of them would have to kind of, at least the majority of them would have to agree on a certain policy. And I don't believe that all 12 of them are going to be in any politician's back pocket. And because of that, I think that you also have to say, yeah, even if he comes in and he's the Fed chairman, he can say whatever he wants. It doesn't necessarily mean that that's what the Fed as a whole, because there are 12 members and they all have a vote. And it's quite possible that a lot of them might not be in agreement, and at that point, they might not necessarily vote. But I do believe that a lot of the Fed decisions are going to be based on inflation. That is the number one thing for them. Is like make sure that prices stay in check, even if the economy might not thrive. I think it's more important to pay attention to inflation, and I'd be shocked if inflation runs high and these folks cut rates. Because when you cut rates, you're encouraging people to spend, which might keep prices high, and that might destroy the credibility. If you see inflation high, I'd be shocked if the Fed is going to vote to lower rates.
Well, with oil so high right now, it's probably not going to last forever, but what do you think about inflation? I mean, do you think it can go either way? Do you think it's unlikely that we can kind of recover from this shock and then we're going to keep having inflation? I mean, I know you can't predict that, but what are
Yeah,
the possibilities there?
yeah. I think that when it comes to inflation, there's no doubt that we're just now starting to see some of the consequences of that invasion, of whatever the war, special military operation, whatever it's called, because it's not just the gas that we pay more for, and we all see this; it's quite visible to us. But the thing is, groceries, like the groceries, when they get shipped from California to New York, well, there's a truck that carries them and that uses gas, and as those prices go up, the groceries are going to go up. So I think you are going to see likely increases in price of the groceries because it is something that I don't know that the producers can absorb and for how long they can do it. But I think it's interesting about inflation in general. We're not looking at like some devastating. We're just looking at creeping up from about, 2.5, 3.5. I mean, it's still like not, we're not talking about crazy level. It's just much more than we're used to, by and large, when you go across the entire basket of goods that we buy. But here's what gets interesting is, and I want to kind of just a little commentary that's on the side is that if you go back to the pandemic and you say, well, this is, the pandemic right here, there have been two recoveries in a way that economists are pointing out, and it's been called a K recovery. And why is that? The minority of the population, so, less than half, and even probably a quarter, whatever, it's not really a precise number, but a minority of the population has had a really nice recovery. And these are the folks who might be in the Bay Area, might be the clients of a financial advisor, white collar jobs, people making decent money. They have seen a pretty nice recovery on their assets. Their incomes are stable. So there are a lot of great news for the recovery after the pandemic for this up branch of the society. On the other hand, you had the more than half of the population who are pretty much on the margin, that they haven't seen an upswing in their assets or wealth or income, and they're the lower branch of the K. And I think that those are the folks who are at the margin because every single month they have to sort of balance their budget very, very carefully because there's not a lot of room, a lot of wiggle room. And the reason I think it's interesting is that when the gas prices went up, a lot of folks who might be on this upper branch might have found it unpleasant. Like, yeah, it's not pleasant to spend more money on that gas. It's not devastating though. I mean, yeah, it's not pleasant, but it's not devastating. And I think with inflation in general, you're gonna see that these folks might slow spending a little bit, or maybe they'll be like, "Oh, I'm not gonna save as much," or whatever it is. But you're not gonna see a huge impact of inflation on the upper branch K. On the other hand, you have the folks who are here on the lower one, and that's where the devastation is going to be. And I'm not sure how many of these have on a financial advisor because they tend to be you're just kind of going month by month, not necessarily having a lot of investable assets. So what I'm hoping is on the folks on this call, you're more on the upper branch where inflation is going to be, it's not pleasant. I don't like it for sure. On the other hand, you're not really being devastated by the increasing prices. When I look at my friends and then like the people that I know that still have good jobs, they're not buying any fewer blueberries. They're just kind of consuming kind of the same. It's just the lower branch, and I think that those are the folks who are going to really be hurt by this inflation because they have to make tough choices at the end of the month as prices go up.
Well, we got a lot of questions that I have at least, and not a lot of time left, but I thought maybe you could just spend a couple of minutes talking about AI and the impacts, the various impacts, both in terms of, well, society to the extent you can, but also just what is it likely to do for the markets and companies? I know
Yeah.
it's a big topic, so we only got maybe 10 minutes left, but
Yeah, so I think it's an amazing technology. There's no doubt in my mind. The last time that I felt this way, that this is magical, was in the 90s when my brother first kind of showed me on a screen how you can put an address and then a picture comes up and a website is like, whoa, this is amazing. This is
yeah.
unreal. So that was for sure something that was as revolutionary as AI is today. And what you're seeing right now is that there are two sort of branches that are coming out. And on one branch, you have these folks who are very pessimistic about where this is going, is that, oh, it's going to take a lot of jobs, in particular the white well-paying jobs. So it's going to be a disaster. People are going to have to think less, and that's going to have huge societal implications. And then you have some folks who are very optimistic, like, look, we're going to be able to create new drugs that we didn't even dream on before. Maybe we can go to a 4-day work week. So there are great benefits that we can reap as society and as individuals from AI. And at this point, they're kind of like both of them might seem legitimate, The answer is likely going to be somewhere in the middle, but it's a little bit too early to tell. It's a little bit too early to tell. And if you want to speculate, there are plenty of websites out there, plenty of videos that you can watch. I think it's a little bit early to say. At the moment, AI still has a lot of issues to work through before it becomes that really incredibly robust technology that we can rely on. And we're not quite there yet. Now, when it comes to thinking of AI as an investment, I think that's an interesting one because right now you do have these AI companies that I mentioned, like Tesla, that have become really expensive because there is an expectation of profits to be made that is just extreme. They might get there, they might not, but it is possible that they're going to make those fortunes. It's also interesting to note that the investments made in AI today, they're just unreal. If you look at four companies, only four companies, and this is Amazon, this is Microsoft, Google, and Facebook. And if you look at 2026 and how much they are expected to spend on AI infrastructure, it's quite remarkable because the Wall Street Journal recently published this. And these four companies are going to cost, they're going to spend more than it costs to land on the moon. But even more interestingly, as percentage of the US economy, there's only one single bigger investment that we've made in the history of the country, and that is the Louisiana Purchase. The second is the investment that these four companies are making in AI. It's a lot more than the railroads, interstate highways, the Apollo space program. So it is quite nuts how much we're spending. And at the moment, there's not like a very clean way to monetize it. It's not like these companies are making money from AI left and right. They're expected to make a lot of money out of AI, but it's not at the moment. But at the moment, what you're all seeing is that these investments are creating great efficiencies for the users. So the point that I want to make here is that there's a great investment that's being made that could be monetized down the road. And because of that, you ought to own a piece of these companies. On the other hand, the users, and these are the logistics companies, the pharmaceutical companies, they might actually benefit at least as much as these big spenders on AI. So it's not a smart idea, in my opinion, to hyper focus on AI. I still think you're better off buying companies around the world in different sectors. But the last thing I'll say is like, I've heard this idea of a bubble. Like, are we in a bubble? And what if it burst? What if these companies are going to go away? And the sort of the parallel drawn to the internet. And if you go back to the internet, and this is like in the 90s, which is also interesting because it's relevant today, the internet was not a monolithic investment. It wasn't an entity called the internet, but rather what you had are companies. And you can think of these companies as horses in a race. And as the race gets going, Mike and Kay, it's not obvious which ones will be the winners. And if you think of back in the mid 90s, and not again with what you know today, but go back and let's say you take a time machine to the mid 90s and you put yourself there, and I would tell you that there are three websites, and the first website sells toys for kids. The second one sells books for reading, and the third one pet supplies. And I asked you, well, which one will obviously become the future of internet retail? It wasn't obvious at all the bookseller that Amazon would become that. So to me, what is important to know is that you have to accept as an investor that in order to own Amazon, you will also own eToysandPets.com. It's just a feature, not a bug. And if you hyper focus on this idea, oh look, but eToysandPets.com, they went out of business, you miss the fact that Amazon became Amazon. You miss the fact that that the same time period launched companies like Google, Netflix, all these companies that have fundamentally changed the world and made the internet an amazing success. And now there are some of the largest, most profitable companies in the world that the humans have ever produced. So again, don't miss the forest from the trees. Don't hyper focus. Oh, but those companies went out of business. But look at the ones that survived. And I think we're in a similar moment today where you have these AI companies, again, which are not a monolithic investment, not an entity, but rather different horses in a race. And at the moment, it's not obvious if it's ChatGPT or Claude or Gemini or you name it, a co-pilot, who's going to be which ones are going to be the ones going forward and surviving and winning this race. And it's too early to tell. And because of that, what we say is like what I think of is don't bet on the horse, bet on the race. And I think that this idea is that means that we have to own all of them. We have to accept that some companies are not going to make it. They're going to blow through a lot of money, create nothing, go out of business. That's perfectly fine. But the ones that survive will more than make up for everybody else. That's kind of the idea. These moonshots are going to more than make up for everybody that doesn't make it. And that's been the pattern in the market over the past 100 years, by the way, Mike. If you look at the US market and over the past 100 years or so, at the beginning of a 20-year cycle, you have about 3,000 companies that trade in the market. And if you fast forward 20 years, what's incredible is about 60% of them disappear. Only 41% of the stocks survive a 20-year period. So don't be surprised if some of these AIs don't make it. It's just we know that's the case. And what's even more remarkable is that out of the ones that survive, only 18% of them actually outperform the market. So it's fewer than 1 in 5 stocks that actually survive and outperform the market. And these are, what you can think of as the moonshots that really deliver the great market performance, despite the fact that more than half disappear. And even out of the ones that disappear, more than half of those underperform the market. So ultimately, I do think that it's very important to have exposure to AI. Don't overdo it. Do it in a global perspective when you have the AI creators, but you also have a lot of other companies, and that to me is the way to capture this, global productive capacity of ours.
Well, great. Thank you very much. Maybe we've only got a couple of minutes, but maybe you can just give us kind of 3 major takeaways, maybe focus a little on the geopolitical, which was the title of this webinar, just, the takeaways there and anything else that comes to mind.
So the first takeaway, folks, is that when it comes to politics, wars, all of this, it tends to be very emotional. And at the same time, the market is not assessing morality, but really bottom line impact on profits. And over, we see that it is, it's a situation where the companies will find a way to navigate what's put in front of them. And markets have shown incredible resilience, despite the emotional impact that an event has on us. That's the first one. The second one, it is really important not to over focus on any one sector, whether it's AI, whether it's energy, whatever the case might be, or any one country for that matter. But try to spread your money into as many companies as possible. And in that respect, I think an Integris portfolio would have exposure to 10,000 plus companies in 40 plus different markets. And then you're ensured that whatever is going to be the great performance, you're going to partake in it. And any changes that happen in the world, you are going to partake into those. And the third one, which is something that it's a takeaway that I should have been to begin with, is that ultimately you don't need to really forecast what's going to happen to the market or what's going to be the outcome of an event any more than you need to forecast an earthquake. I mean, we live in California. We know at some point there'll be an earthquake, and the idea of like my definition of success is the ability to forecast. It's not really productive. A better way to think about it is that don't try to forecast these events or what's going to happen. Think of them as earthquakes that come in unpredictable strength and unpredictable times. But what you can do is prepare, have a plan. And that's what Integris, and that's why I think it's the most important element in investing, is make sure that you have a plan. And that plan takes account of your specific needs, your circumstances, your risk capacity, other assets that you have. And blends together, maybe the growth potential of stocks with the stability of bonds, specifically to you. And when a situation comes up, you would be surprised that the results that might be in your portfolio are actually quite different. That is what is on the news. because
Yeah.
most of you might not own the S&P on the news, but you have that plan that was built to withstand for your specific needs and circumstances. So don't look on the news and say, "Aha, this is what's happening in the world of the market. That's what's happening in my portfolio," because that's not the case. Quite often, your plan is very specific to you and might have other pieces that helps you balance this.
Thank you. Well, I really appreciate you joining us, Apollo, today, and thank you to everyone on the call. If you did have a question that didn't get answered, we'll get back to you on that. And if you have additional questions, feel free to reach out. We're happy to connect anytime. So, again, thanks, Apollo. Really appreciate it. And thank you to everyone for joining.